Hello there, David Coe with the Coe Real Estate Group. Hope you're doing well. It's been a crazy 10 days with what's been happening with banks. Last week we had the collapse of Silicon Valley Bank and Signature Bank, and this week we almost had a run at First Republic until finally the banking industry kind of came back to backstop it. And a lot of people have been wondering, is what's happening right now, is it similar to what happened in 2008, and are we looking at another potential, catastrophic or contagion in the banking industry? And I'm going to give you some facts today that show why it's a completely different situation than what happened in 2008, mostly as it pertains to mortgages. So back in 2008, a lot of the problems banks were having were due to loans that were given to people that really couldn't afford to make those loans. With legislation that's happened since then, mostly with Dodd-Frank, it's a completely different mortgage situation than it was 2008. So here are some facts why today is different than what happened in 2008. Number one, in 2008, only 30% of homeowners had a credit score of over 720 versus today, 70% of home loans have a credit score of over 720. So we've been making loans to better borrowers that can actually afford to make the payments. Number two, in 2011, 1 out of 4 homeowners were upside down, meaning they actually owed more on the property than the property was worth, which is why a lot of people just gave those properties back to the bank. Today, the average loan to value on properties is 45%, meaning homeowners have 55% equity in their property, and over 69% of homeowners actually have either 50% of equity or own the home free and clear. So a lot of equity that people are going to be less likely to walk away from than it was in 2008. Number three, the average home loan in 2006-07 and when those loans were given was 5.4% versus today, the average home loan is 3.8%. So a majority of Americans have a loan that's below 4%, which has been one of the issues, why homeowners have been unwilling to sell. They don't want to lose the great rate they have. Number four, in 2007, there were 13.1 million loans that were adjustable rate mortgages. So when those loans all of a sudden readjusted and people couldn't qualify for a loan, a lot of those properties went back to the bank. Today, only 8% of loans are adjustable. So most people have been, locking in 30-year rates when rates got so low a few years ago. So we have more stability in the housing market. Number five, in 2009 and 2010, there were almost 3 million foreclosures each year. So 6 million foreclosures in a 2-year period. In 2021, there was 151,000 foreclosures. In 2022, there were 324,000 foreclosures. So versus 7 million in that 2-year period, in the late 2000s versus less than 500,000 in the last 2 years. And then finally, in 2007, we had almost 10 months of inventory versus right now, we have a couple of markets that are hitting 1 to 2 months of inventory. So we're still in a fairly low supply environment, which is why prices have been stable. And because of what's happening with the banks, we actually are starting to see a reduction in rates. In the article below, you'll read that interest rates have come down. And actually in the last 5 weeks, interest rates are almost down a full 1% or 100 basis points where they were. We were right around 7% almost about a month ago, and we're back down in the low 6s. So, while it's been a crazy couple of weeks here with banking, this might also help to balance some of the Fed's moves. And instead of raising their Fed rates over the next couple of months, they may not want to create further chaos in the banking industry, and may stabilize some of the Fed rates, which will help interest rates, and we think is going to help buyers that are looking to buy and sellers that are looking to sell. So anyway, hopefully that adds some clarity to why what's happening with banks today is different than what happened when the last crash happened. If you've got any questions about your mortgage or your piece of real estate and want to have a conversation with myself or someone on the team, we'd love to talk to you. David Coe with the Coe Real Estate Group. Thanks for watching, and I hope you're doing well.